The stock market is a leading indicator of economic times. It's not a follower, it is a leader. It's all about trying to keep you guys focused and knowing that there's going to be a down day. Wall Street makes money by transactions. The more transactions you have, the more money they make. All right, so tonight we're going to talk about the benefits of international investing. And as you may know, if you've analyzed your portfolios, we have a fair amount of international stocks in our portfolios, as well as bonds. And there's a reason for that, and that's what we want to talk about tonight, why we do. We traditionally, as investors, we've had this fear that international stocks are too risky or they're too scary. And so we'll try to take away that myth that they're higher risk than what U.S. stocks are. And the reason is if you go back 20, 30 years, you know, a lot of it is the lack of knowledge. We've never been in that country. We don't understand their language. We don't understand their culture. We don't understand a lot about those countries. So we have fear of investing in those countries because we aren't really sure about it. So a lot of times, and this goes back to even your whole portfolio, and the reason why we have these education classes is fear and lack of peace of mind comes from lack of knowledge and understanding of what we're invested in. So the idea of coming to these classes regularly is to get a better understanding and repetitive, and eventually you start to get it, you start to gain that peace of mind. And so this is critical that we have peace of mind with our money. It's very hard to do, but that's what education's about, and always understanding, why do I have this? How does it work? That way we block out news media, which can exponentiate what kind of issues are going on. And we've been through that in some of our past classes, talking about how news media can affect our thoughts. So let's talk a little bit about international investing. If any of you have been in our conference room since Christmas, thanks to Michelle, my Christmas gift, she got this big map which has little magnetic pins on it. You can't see them on here. But since we're talking about international investing, I had to take a picture of this today because there's magnetic pins on 45 countries on that map. And the reason why they're on there is because that's where we're invested in our portfolio. So it's kind of cool to be able to see where you're at. And by the way, let's see if I can figure out, where's the pointer? Whoop, uh-oh, I don't do that. This is a new little button here. I guess I won't have my pointer. Anyhow, maybe that's what that is. Yeah, right here is Russia, and here is the Ukraine right here. Well, there's no pin there, so you guys can all relax tonight. We have no pins in that area, all right? Now, I'm not saying that there isn't some countries in the Balkans and up in here that we have pins and might do some business in Russia, but it's very limited. And we're going to talk at the end a little bit about what's going on in the marketplace and what I'm hearing from money managers to give us an idea of, you know, is this going to cause problems and some of that. So we'll talk about that when we get through this. So a couple things that we need to know for terminology's sake, just to be a little clearer, because when I go whistling into the conversation or as I go through the PowerPoint, you're going to go, what's he talking about? So I'm going to talk about efficient markets. And we've talked about this many times. And it's still a hard thing to grasp because you go, efficient markets, it really doesn't click. You know, it's kind of like the Wall Street lingo. But what efficient market is, all knowable information about the future is already factored into the price today. And only random, unknowable information is going to change prices moving forward. So what they're saying in an efficient market is we believe that the market is efficient because stock prices are always accurate, okay? Now, there is little twitches where a stock price might be inaccurate, but what that means is that a stock price is always accurate based on all knowable information at the time. So right now, if XYZ Corporation is $80 a share, it's the right price for that stock. And this goes back to where I've talked about cans of soup, okay? Campbell's soup, any kind of soup, grocery store, if the price is too high, nobody buys it. If the price is too low, everybody buys it. And if everybody's buying it because the price is too low, what happens? They bring the price up. That way, the price of that soup is always an accurate price. That's an efficient market system. Because if it wasn't the right price, then one of two things would happen. Either nobody would buy it, and the warehouse would be just packed because it's too high, or everybody's buying it and they can't make it fast enough. If you can't make it fast enough, you're going to raise the price. Same way with stocks. When you sell a stock, there has to be a buyer on the other end. And that buyer has to think it's a fair deal as well as the seller. So if I have an XYZ corporation and the stock valuation today is $80, and I want to sell my 1,000 shares of that XYZ corporation, there has to be a guy on the other end or gal that thinks that that's worth $80 because they're buying it. Somebody's buying it somewhere. So that means that even though you and I might think that $80 is high, somebody over here thinks it's low. So that tells you that the price is always right, because if you thought it was worth 80 and nobody else did, and you want to sell that, the broker's going to go, well, we can't get 80, but we could get $76 for it, and you're going to end up selling it for 76 because somebody on the other side thinks that's the fair value, and now all of a sudden that stock price is accurate again. And this happens in milliseconds today. It's extremely hard for an individual investor to play the game of inefficiencies. So inefficiency in the market is what active speculators do. They're trying to play that price movement that happened just now, and it's off just a little bit, and I want to buy it because I think I can get it for sometimes, well, pennies to nickels to dollars. I can get a deal. Extremely hard to do anymore. So we believe that markets are efficient, meaning that the stock price is always accurate. That's one term we have to remember when I talk about efficient markets. Then we talk about active management. And what is active management? We are doing active management in our portfolios. Doesn't mean that we are completely passive in our portfolios. It just means we're not active. What is active? Refers to portfolio management strategy where the manager makes specific investments with the goal of outperforming an investment benchmark index. So I'm going to compare money managers tonight versus indexes. Okay, an index is a benchmark. It's a piece of the market. The S&P 500 is an index, which is made up of 500 large stocks in the U.S. That is a market segment. It's not the whole market. It's just a little piece of the market. The NASDAQ is made up of 100 companies, and it's the tech stocks, mostly, of the United States. Large tech stocks, some small tech stocks. You have the Dow, which is another market segment. Dow is an index made up of 30 companies, mostly large cap, most large company stocks in the U.S. So what an active money manager does is he thinks he can find those inefficiencies in a price of a stock, okay, and he can buy it or sell it. And this is what we're talking about here. Ideally, the active manager exploits market inefficiencies. Okay, we believe the market's efficient, which it really is. But there is a rare occasion of inefficiency. It's got to be very quick. You've got to be really, really fast at it. It's very hard to do anymore by purchasing securities that are undervalued by short selling those securities that are overvalued. So they're buying when they think something's undervalued, and they're selling short when something's overvalued. So we don't do active management, but these are just two terms we're going to talk about tonight. I'm going to bring up efficient markets, and I'm going to bring up active management. So just to give you a little base on that. Does everybody follow me on that? Okay. So let's talk about a couple myths here. You know, I'm big on myths. Mattson Money's big on myths. We always like to talk about myths because there's so many myths out there. So myths are that international markets are less efficient than U.S. markets, therefore active management should work. Well, let's see. So here we're taking the, up here we're taking a large company mutual fund manager, international large blend fund of managers. So this is made up of, I think in there it shows 519 different money managers from the time period 2002 to 2011. And they're comparing it to the EFA index. The EFA is Europe, Australia, Far East Index. It is large company international stocks. The S&P 500 is large company U.S. stocks. The EFA is large company internet. Did I just say that wrong? S&P is 500 U.S. large. EFA is large companies outside the U.S. Okay? So what we're looking at is you got these mutual fund managers, 519 of them, and here's a 10-year period, 2002 to 2011. How many of those, these are active money managers, these are guys that are trying to pick those inefficiencies out there. How many of them beat the market over that 10-year period? So if we look across here, we can see that 0 of them beat it 10 years in a row. So 10 out of 10, none of them did it. Okay, it's impossible to do. You can't do it in the U.S. It's impossible to do on a consistent basis. Doesn't mean it can't be done, it's just really hard to do. There's only 1% of that 519. So what's 1% of 519? 5. 5 of those money managers out of 519 beat it 9 out of 10. 2%, so now we're at 10 money managers out of 519 beat it in 8 out of 10. And 7, there's 6 of them, so what are we talking, 6 times 30 some? So can you imagine trying to find out which money manager is going to beat them that 10-year period? We don't know that. How we get, this is hindsight. So it's very hard to find a money manager that can beat the market, beat that index itself. The index is efficient. The active money manager is trying to play those inefficiencies, so it just shows it's really hard to do. Actually, if for someone to beat the market more than 5 years out of 10, more than half the time, you add all these together, that's 22% of 519, so about 100 money managers beat the market more than half the time out of that 10-year period. That's 100, so that's 1 out of 5. So you got to find a money manager that's going to do it for the next 10 years. It's almost impossible to find. It's hard to figure out either. No, this is a percentage of all 519 that I don't know who they were. We don't have that list. Whoever the 519 large cap international money managers were at that time. There was only 519 of them in that category. We have a slide that will show one of the American funds in there, but I don't know because this doesn't give me, this is just a compilation of all of them. But if you look at this, you can see that this thing is highly tilted to the left. That means less than half the time, these money managers can't beat the market. Okay, you follow me? The highest percentage, 21% of them only beat it 3 times out of 10 years. So why don't we just buy the market instead of trying to play that game? That's the point of this. And actually, if you just take the odds, if you flip a coin, we've done that in some classes, that 50% of the time, half of them should beat the market and the other half shouldn't, right? Normal odds, random luck, which is the blue curve here, shows that they can't even beat random luck because this thing's tilted more this way than it is this way. So they can't even beat the random odds. So let's go back here for a second. So if I'm looking for a money manager to invest in internationally, then I want to find these guys, right? How am I going to find these guys right here? I certainly don't want all these guys down here because they're not going to do me any good. I want the top couple guys. So what are we going to do? We're going to use track record investing. Okay? Track record investing is looking to the past. If a money manager's done a really good job in the past, then surely he's going to be able to do a really good job in the future. So we call that track record investing. And let's look at that once. So if we look from 1992 to 2001, these are the top 20 international funds from that period of time, that 10 years. You got a bunch of familiar names, Allianz, Morgan Stanley, American Century. I don't see any American funds in this one. There is in the other one, Vanguard, Oppenheimer. These are the top 20 mutual funds from 1992 to 2001 dealing in international funds or international stocks. Then here's 2002 to 2011. So here's 2001, and here's the next 10-year period. And if you look in here, there is an American funds. I saw it in here somewhere. Yeah, maybe not. Must be in the last one. Right here, Euro Pacific Growth Fund. Yeah. But that was in 92 to 2001. So now we go to 2002 through 2011, and here's the top 20. So here's my point. If it's 2001, all right, and I'm looking to invest some money, what am I going to do? What's my advisor going to do, or what am I going to do? I'm going to go try to pick 4 or 5 or 6 of these guys, right? Well, they've done pretty good for the last 10 years. They're top 20 mutual fund guys. I'm buying some of that. It's called track record investing. I'm looking at their track record. So then we go to 2002 and 2011. Here's the top 20, but let's see how that worked if we would have done that. If in 2001 we would have bought the top 5 or 6 mutual funds out of that top 20, just to, because we thought that they were going to be tearing it up, the average return from 92 to 2001 of those top 20 mutual fund managers was 10.66. The EFA, the index, returned 4.76. So they slaughtered the index, did they not, during that 10-year period? The top 20. Now, we got 519, probably more than that during this time period, but say 500 money managers at that point, and the top 20 of them slaughtered the market. Okay, so in 2001, we decided we're going to buy some of these guys, right? Because we're thinking, hey, these guys are wizards, man. They're doing a fantastic job. So here's 2002 through 2011, those same 20 mutual fund managers, the exact same ones, averaged 4.17. So they couldn't repeat the 10.66 again. They did do 4.17. They didn't meet the market this time. They didn't do bad, but the point is that these 20 didn't quite do what we thought they were going to do, and we had our expectations high from the first 10 years. So the question is, what percentage of the top funds in 2002 through 92, the top ones in the first 10 years, how many do you think were in the next 20? Has anybody got a guess? 25%? None? None? Well, you're right, it's 0. So none of the 20 in the first 10 years were in the second 20 years. So what's the benefit of owning some of those in the first 10 years? Not really any. So what the point of this is that international markets are efficient, the indexes are efficient, and it's difficult for money managers to beat the index itself over long periods of time. And that's true in the U.S. and it's true in the internationals. And they're starting to find, by looking at all the international statistics, because we're now starting to get good data. Really, data back till 1970 is really when data started internationally. Prior to that, nobody really kept good, solid track of it. But now that they're getting some history, they're starting to see that markets work almost identical internationally as they do in the U.S. But they work a little differently, and we'll talk about that. So any questions on that? Want to buy in that first 10 years? Anybody want to buy some of those mutual funds? All right, so the next myth is if you add international stocks to your portfolio, you're going to increase your risk. So this goes back to, we always think in the past that international stocks are risky, right? I got to keep lubricated there. So international stocks usually you think of that they have a higher risk. So let's look at that once. So if we go in here, the red is the S&P 500. It's the largest U.S. stocks. And then we have the EFA, which is the international large stocks. So from 1970 to 1987, we'll see that the EFA kicked the U.S. butt by about 4%. That's a, 18-year period? So the international large company stocks outdid the U.S. In 88 to 99, you'll see that the U.S. large company stocks pretty much showed the internationals up quite a bit. What is that, about twice, 2 times? Then in a little 2 or 3 year period here, 2000 to 2011, they were almost even. And then if you take the whole entire period, 1970 to 2011, we don't have 12 or 13's numbers. Hopefully we get them soon, but we're waiting for updates. But the 11 is the last time they did this study, I guess. You'll see that they run pretty darn close to each other over a long period of time. But if we go back through those periods of times, we can see that one's doing better than the other one's doing better than the other. So what that tells us is that stocks, we need to buy international stocks. Even though they end up with the same result over a long period of time, they are a great diversifier. Because if we just bought all U.S. stocks during this time period, we would have made 10.25 average annual return. But if we had this, we would have made more return. But if we would have just, then after this, we would have just bought internationals only, we would have missed this run up. So when one's up, another one may not be up so much, but when another one's not doing so well, another one's up. So this is why it's such a great diversifier. It lowers our risk because we're not caught up all in U.S. stocks that are doing this. We're caught up in a couple different things doing this. And it evens out our roller coaster ride, our volatility. So it doesn't increase risk. It gives us about the same return, but it actually offsets risk. We'll talk a little bit. We're going to keep going with that. Okay, does that make sense? So then we're going to look at small caps. So when we've talked about our mutual funds, we have a weighting towards small cap stocks. We have a weighting towards value stocks because value stocks return the highest return of stocks over long periods of time. They do better than small company stocks over long periods of time. And small company stocks do better than large company stocks, and large company stocks do better than bonds. So small company stocks do better than large company stocks. So let's see if this holds true internationally for small company stocks. It almost looks the same. If you look at the CRSP 6 through 10, okay, that's the Center for Research of Stock Pricing. It's out of Chicago. It's an index, and it's 6 through 10, which means it's the smallest half of the all U.S. stock market. So to clarify that, CRSP 1 through 10 would be every stock available in the United States. 6 through 10 is the smallest half of all those stocks, smaller companies. So, and then we have the International Small Company Index. So if we compare those, you can see that the CRSP is in green and the internationals are in the orangish yellow or yellow gold. In 1970 to 87, you'll see that the internationals dominated. If we go to 88 to 99, you'll see that the U.S. dominated quite a bit, by 3 times there. They doubled us over here. 2000 through 2011, again, pretty even run for small stocks. And if we look over a long period of time, you'll see that international small stocks performed a little bit better than U.S. small stocks. They do have a higher risk if you just bought international small stocks. They would have a higher risk element because they give us a higher return. But we want to blend them in our portfolios because it's another volatility. It smooths out our volatility. It's another diversifier because when one's up, the other one might be down and maybe not doing as well. Then the other one's, we don't know what year one's going to be higher than the other. So we want to own a little both of it so that we get that diversification, smooth out that ride over a long period of time. And it's absolutely essential, if you're going to do this, that you have a money manager that rebalances. Okay, so our money manager rebalances every 3 months on a quarterly basis. So what would they do here? They would take what's high, spin off, and buy what's low. And over here, okay, so they bought this low, then this ran up the next 10 years, they spun that off, bought what was low here. So they're always spinning off what's high and buying what's low. They do it automatically every 3 months, no heart. It's a science, they do it. And that's absolutely critical to win the game over a long haul. You want to always be rebalancing. When something's got a high run, because it isn't going to high run forever. One particular asset is never going to run forever and ever and ever. It's always going to run, and then it's going to have a fall, and it's going to run. So we want to have stuff that's getting runs at different times. I like how they put past performance is no guarantee of future performance. So all this right here, throw it out the window because it really doesn't mean anything. But it is long periods of time, and it gives us a pretty good idea how to diversify portfolios. So why invest internationally? Well, I just talked about diversification is the main reason we want to invest internationally because it gives us that, when the U.S. market isn't doing so well, it gives us that opportunity to possibly get some returns in our portfolios. Also, we want to be able to pick up those international value and small stocks because they will give us a higher return. And if we blend them in an overall portfolio, we're not taking additional risk to pick up the returns from those. If we went out and bought international value or international small stocks, just those, we'd be taking a lot of risk. We'd get a high return over a long period of time, but you're top fuel dragster at Cedar Point, so you better be ready to take the ride up and down. It's an emotional ride, and we don't want to do that. I don't think there's too many people in here that want to take that kind of a ride. I have clients that like that, but I don't recommend it. So we want to be prudent, and to be prudent, you got to diversify with all these different things going on so it smooths out that diversification ride. So now the other part of the piece is called correlations. So if we go back to, we'll just go forward. So what is correlations? Correlation charts are designed to tell us what moves in the same direction at the same time or different times. Something that is not correlated would mean it moves in complete opposite direction. So here's a perfect example. Most cases, not every case, but when stocks are up, bonds are down. And when stocks are down, bonds are up. They're not correlated. They move in opposite directions. It's the simplest form. 2008, they all failed. So we got to throw that year out the window. So if correlations are all these the small company stocks, these value stocks, these large company stocks in the U.S., large company stocks in the international world, how are they correlated to each other? So this is the science behind all this. We aren't just buying a bunch of stuff and throwing it in a portfolio and go, oh, I hope we hit something. There's a science as to actually why they're doing it. So if we look at right here, you'll see the EFA, okay, so this is the large cap international stocks, and you'll see the S&P 500, you'll see they're pretty highly correlated. One means they're 100% correlated. That means they move in the same direction at all times. So U.S. large company stocks and international large company stocks are 80% correlated. That means 80% of the time they're moving in the same direction. When one's up, the other one's up. One's down, the other one's down. So that's what we call high correlation. They're highly correlated. However, if we go over here and look at, let's look at the large with the this would be U.S. small stocks, the really small stocks in the U.S., and you'll see 0.67. So now we're getting into a medium correlation. That means 67% of the time, 2/3 of the time that international large stocks are up, 2/3 of the time, basically, small U.S. stocks are not going up, or going up as well. So 2/3 of the time they're correlated, 1/3 of the time they're moving in opposite direction. So whenever these guys design these portfolios, they want to know historically what these different assets have done compared to each other. And that's how they design what percentage goes into each thing. These are well thought out. So the next diversification step is emerging markets. So we think of emerging markets usually as these countries that are just completely undeveloped and they're just really starting from scratch, and man, that's got to be high risk because they don't have anything. I think we have about 20 or 21 stocks in the emerging markets in our portfolios that are considered emerging markets. Every emerging market stock that we own are in countries that are developed countries. They're just underdeveloped compared to the United States or Europe or China. China was an emerging market, still considered somewhat an emerging market, although it's fairly developed now. It's the second largest economy in the globe, so I'm guessing it's not really an emerging country anymore. So we're not going into countries that are beginners. They have to have a stable government, they have to have a system, they have to have a free market. In other words, there has to be a business system in place in that country where there's buying and selling of goods. It has to be a legitimate country. I'll give you an example that is not quite there yet. That is a pre-emerging country, according to our portfolios, Vietnam. A lot of manufacturing going on in Vietnam today. But it's an unstable government. There's still too much corruption. There's not enough free market system. It's a place that you don't want to go invest in right now. There's people investing in there, but you got to be willing to speculate and gamble. We're not willing to do that. So we're looking for countries that have established governments and have a good system in place. They're just really small economies of scale that are working on growing. So we need to have emerging markets because they have a higher expected long-term return. All right? It's not that they have all this huge growth potential. It's just that overall, long periods of time, they will do a little bit better than a established country because there's lots of opportunities going on. Low correlations with the U.S. and international large indexes. So remember back to that correlation chart? emerging country stocks have a low correlation compared to large US and large Europe. So maybe the large company stocks, remember Europe or international, the EFA and the S&P 500 are highly correlated. So when they're down, emerging markets tend to be up. Last year we had what, a banner year in the US? I think the free market US fund did 39% last year. The emerging market part of our foreign or international mutual fund lost 3.3% last year. So emerging markets didn't do really well last year. But who's to say they don't do really well this year or next year? We don't know. So we need to own them because we're going to get some benefit out of it in the long run. So here we go with a chart that shows us the MSCI. This is the Morgan Stanley Index of Emerging Markets, the S&P 500, and the Morgan Stanley EFA, which is the large company. So here, let's look at these correlations and let's look at what actually happened. So over here, 88 to 1996, so we're talking, 18 years again, something like that. You can see that the emerging markets dominated at 22%, the S&P did 16.47, and the international larges did 6.76. Then 97 to 99, so we're only talking 2 or 3 years, the S&P dominated, the emerging markets didn't do so well, and the large cap internationals did decent. We look at 2000, 2010, just a 3-year period, we'll see where the emerging markets did really well, and the large US and the large Europeans didn't do so well. So if we look at that whole time period from 88 all the way to 2011, we'll see that the emerging markets actually beat everybody. And so this is what the ending average annual return was over that period of time. Again, we have diversification because we don't know which one of these is going to be hot for that 10-year period, and we can see that it's different all the time. And if we get caught up in just one segment, we miss what possibly is going on in another segment. Does that make sense? Anybody falling asleep yet? Get the gun out. No.
Would you say, Brad, that during that period, the S&P would be where you want your money to be?
Well, it could, but right here, it didn't really do any better than the emergings took over. Emerging took over here, emerging took over in the long term. So I don't know. I think you need to be mixed in all of it. It's really hard to pick them. You got to remember during that period of time, we had the 90s in there. Remember, you could throw a dart at anything and make money in the 90s. So remember that too. So again, past performance is no guarantee of future performance, but if you go back historically, they can go back 80 plus years in the United States. These things hold true in the United States, and they're finding out with well over 40, 50 years of international studies that the same thing holds true internationally. So there's not really a lot of difference. It's just you can't prove back 80 years on the internationals at this point. Okay? So here's emerging market correlation. So here's some of the countries that we're in. See if I can get a little. You got Brazil, Chile, Mexico, Czech Republic, Hungary, Poland, Turkey, China, Indonesia, Malaysia, Philippines, South Korea, Taiwan, Thailand, and India, and they go back down the same way. So here's a perfect example. The light green is low correlations. The red, of course, is high correlated, but if you look at that, India compared to India is 100% correlated, right? So you got to forget the red, but the green is, the blue is the lowest correlation, green is the middle correlation, yellow is a high correlation, and so what we want to look at is, let's just give it, here's Czech Republic, and go down here and cross it with China, and you can see that 0.197, so 0.19 is the correlation, which is a 19% correlation. So only 20% of the time do they move in the same direction. 80% of the time they're in total different directions. So this is why it's so critical to add this emerging market in there, but then we've got to look at how are we going to diversify this thing geographically. Now we're looking at just emerging country stocks, and we got to figure out how much do we buy in this country, percent in this country, percent in this country. So now they got to, the money managers got to analyze all this and go, what percent do we do and how do we do it? Instead of just buying a bunch of stocks in those countries, you got to figure out what's the science behind it. If you go over here and look at Turkey compared to India, just as an example, 39.5, so about 40% correlated. So 40% of the time they're moving in the same directions, but 60% of the time they're moving in opposite directions. So you're starting to get it. It's kind of like orchestrating this thing instead of just being caught up in S&P 500. And when it's up, it's up. When it's down, it's down. It's up, it's down. We get emotional because it's this hilly ride. But if we got a lot of stuff, we're going to smooth it out. Doesn't mean we're not going to have ups and downs in our portfolio. We're still going to have them. That's part of making money. You got to take some risk. To take risk to make more than what you're going to make in the bank. You got to be willing to take a little risk. But we can take risk prudently if we do it right. So the other piece of the puzzle then, in international stocks, excuse me for a second, I need a drink of water now, is trading costs. It does cost quite a bit more to trade stocks internationally. Hence, active money management overseas is a costly experience. If you ever check mutual funds that you would have, you look at the expense ratio or the expense fee in international active mutual funds, you'll see that they're usually higher than anything else because of the cost of trading. So our approach of buying structured portfolios, our portfolios are what we call structured market portfolios. They are not index portfolios. They are not active portfolios. They are structured portfolios. We're buying based on structures of all this stuff we're talking about. Diversifiers, we're talking about correlations, we're talking about all the different asset classes from micro small stocks to giant large stocks in all these 45 countries and looking at all the correlations of all those. That's a structured portfolio. Index portfolios means I just go buy a bunch of indexes. But the problem with index portfolios is they have to turn stocks every year. The S&P 500 has to relook at their 500 stocks, make sure they follow the ratios, and they'll trade them out, put new ones in each year. Same thing with all indexes. So we don't want to buy just indexes because they are forced to make trades. So if we do structured portfolios, there's no reason for us to trade other than to rebalance. And we can do that very cost efficiently in our portfolios. And I'll talk about that in a minute. So if we look at the estimated cost basis to do trading in here, if you see our structured investment strategy will minimize the cost. So if we look at, given already the high cost of international investing, if someone has a lot of turnover, which is these active money managers that are buying and selling and trading all day long, that just makes this thing outrageously crazy. So let's look at a couple of these in here. You'll see, let's go down here to Austria, for example. Commissions, 30 basis points. Custodial transaction, 5.5 basis points, 35.5 basis points. And if you read this, this is a buy-side trade. That means that's just the cost to buy. Now, let me go back for a second, because what a basis point is that's 1/100th of a percent. So I'll give you another example. See this 100 basis points right here? That is 1%. So 20 basis points is 1/5 of 1%. Does that make sense? So in the bank, you're earning 0.05. Okay, you get that? 0.05 would be what? If 1 basis point is 1/100th of a percent, you'd have 5/100ths of a percent in a checking account, let's say. So 1% or 100 basis points equals 1%. So if we look at Austria, you can see that 35.5 means that almost a third or a little bit more than 1/3 of 1% is what it costs just to buy a stock. And they're buying small cap stocks and they're spending $50,000. Now, if I buy it, then sometime I might want to sell it. So what's it cost to sell it? I don't know. We don't have those numbers. But a round trip means I buy it and then I turn around and sell something else and I buy something. That's active trading. It costs a lot of money to do it. And they don't have to disclose all these, by the way. But here's I saw this one that stuck out to me. Ireland, 20 basis points, 100 basis points for a stamp duty, some kind of tax, 2.4 for custodian, 122.4. So just to buy a stock, that's 1.22% of the cost. That doesn't, maybe, okay, on 50,000, what's that? $5, maybe. But if you're doing that 100 times or 150 times a day, or way more than that. Some of these guys are turning portfolios 110, 120, 130% a year, actively trading, trying to beat those markets, trying to make a buck. Of course, they're making money. So these costs are really a big thing when it comes to international investing. So you want to try to get into a structured portfolio where you're eliminating all that transactional cost. So let's design a portfolio and see if actually we go into international stocks, if it really does increase our risk. So the first portfolio is 100% U.S. large cap stocks. The second portfolio is we're going to take 40% out of that large cap and we're going to put it in international large company stocks. That's portfolio 2. Portfolio 3, we're going to take that 40% international and we're going to split it up into international large and international small. And then portfolio 4, we're going to really diversify a little bit more. We're still going to keep 60 here, but we're going to now break up this 40% into international large, international small, and now we're going to throw in value stocks because value stocks have the highest return of all stocks. So let's see how these portfolios, because what most people would think, if we got all these small stocks and these value stocks, man, we're really increasing our risk here. But we're really not, I don't think. Let's see. So we got, what is this, 1982 to 2011, and they're rebalancing on an annual basis during that time period. Portfolio 1 returned 10.98% per year during that time period. What is that, 82 to 2011? Is that 30 years? Not quite, 28 maybe. And then we look at the standard deviation, which is 17%. So remember standard deviation? Most all of us have been through that when we first did our portfolios. That's how much risk or how much of a volatility number you're on. Remember, Treasury bills over a 40-year period have about a 3% standard deviation. Treasury bills are considered the safest thing to invest in because they've never had a negative year. So 3% is very safe. 17% is this is the S&P 500 right here. If you read this right here, S&P 500. So the S&P 500 top left has a 17% standard deviation. It can fluctuate 17% on a given day or a given year or however you want, over that period of time. So 17% is probably a little bit more higher than what an average balanced moderate type investor would go into. This would be a growth investor type standard deviation. So just remember, the lower the number, the less the roller coaster ride. The higher number, the higher roller coaster ride. So if we go and we add some international large stocks, now we lowered our actual portfolio return to 10.55, and we actually increased our risk. Not by much. It really didn't change much. That little difference from there to there is not a huge volatility change. But if we add some international small stocks in here, now we're starting to get our portfolio up a little bit. We went to 11.5 when we originally started with an average return of 10.98. So the small stocks are giving us a lift. Let's see if it gave us more risk, though. Did it give us more risk? Standard deviation 18.11. Barely changed from this portfolio, and it isn't much higher than that risk in just owning U.S. large company stocks. So now we picked up, what, 0.5% return per year over that time period, and we really didn't increase our risk much. This is the idea of trying to get these assets that are low correlations, picking up all those little pieces and parts, and we're happy to get 0.5% or 1% even more per year. It all adds up over a long period of time. So if we look at portfolio 4, we got all these little pieces and parts. Now we went up another 0.25%, so we're at 11.78. So we're about what? Not quite 1 full percent higher per year average return. And our risk didn't change a lot, 18.43 compared to 17.32. So we added small company stocks and value stocks, which give us the highest return, who have really high risks. But if we do it right, the science of it, we aren't taking a whole lot more risk, and we're picking up almost a 1% additional return. Doesn't seem like a lot, but like I said, it all adds up, especially year after year after year. Any questions on that? So let's look at this thing in conclusion. We know that active management can't beat the market even half the time. Most of it is less than half the time. So it wasn't really effective. And track record investing, if we'd have followed that track record investing, it really didn't do us any good either. So we figured out that neither one of those really worked. We combined international investments with well-diversified U.S. stocks. We can reduce the overall volatility in our portfolio or keep it close to the same, but we can also increase returns by including small cap value, emerging markets. That can help us get that higher return without taking additional risk. It's all about diversification. And we must, if you're going to invest internationally, you must keep your eye on turnover, because it's a high-cost playing game over there. It's not as cheap as the U.S., believe it or not. It's way higher. So that's pretty much about international stocks. Any questions? Let's go through a couple of these. Are you invested in the market? Well, if you have mutual funds that are stocks, you're invested in the market, right? Do you know how markets work? Well, we kind of talked a little bit today about how markets work. Correlation charts, international versus U.S. So we're starting to learn this in the back. There's a chart. You can answer yes to this if you're 100% sure you get it. If you aren't, answer no. And the reason how you're going to get, you know how you're going to get yes on all those? You got to come to these classes regularly. I know how to suck you guys in here. If you come to these regularly, you'll start to get yes answers on all those. Have you defined your investment philosophy? If you don't know that, then that's a no. If you know what it is, it's a yes. Have you identified your personal risk tolerance? Okay, now we're talking about that standard deviation. Do you know what risk tolerance you're willing to take? Some of you might have just talked about it recently and aren't sure yet what risk you're willing to take yet. Do you know how to measure diversification in your portfolio? We just talked a lot about measuring diversification. A lot of that has to do with the correlation charts. Can you consistently and predictably achieve market returns? So if you're in active money management, are you beating the market? How do you know? Nobody ever asked that question. We are buying the market, so we better be beating the market, or at least doing what the market is, or something's wrong. We're beating the market, I can tell you that. Have you measured the total amount of commissions and costs in your portfolio? I hope you know what the costs are. And if you don't, then guess what? Dad, we're going to raise the costs up to them because they aren't paying attention. So, oh yeah, maybe we should raise your hand if you don't know the answer to that one. Do you know where you fall in the Markowitz efficient frontier? If you remember when we originally did this, there was this curve. You're on the efficient curve. If you have a Matson portfolio, that's why they rebalance to keep you on the curve. And when I go over that stuff, I usually go, you are here or you're right here on this in the universe of investing. So, hopefully, if you don't know, then the next time we get together, say, where am I on that efficient frontier anyhow? And I'll show you. When it comes to building your investment portfolio, do you know exactly what you're doing and why? Well, we talked about that today. Now, whether we can all do it ourselves, that's a little different story, but at least we know why they're doing what they do and why they do it and how they do it. Well, how they do it's probably a mystery. Are you working with a financial coach versus a financial planner? Hopefully you think that I am your coach because I'm here to help you and guide you and educate you. A financial planner would just go, here's what you need, and see ya. And then you walk out of there going, well, I'm not really sure what we did. I hope he did the right job for me. So the coaching part is critical to educating you, and education leads the peace of mind. You have a customized long-term game plan to guide all of your investing and spending decisions. So hopefully all of us sitting here have some peace of mind because we've sat down and structured what your assets are. There's a reason and purpose for everything. If you don't feel comfortable with that, then we need to meet and go over all that again. But that's what the lifelong game plan is all about. Do you have an investment policy statement? It's a written statement. Everybody that has a Matson portfolio, if you open up your book in there, is an investment policy statement. It's all the stuff that we went through to define where we ended up, what mixture of risk that we took, and why we did what we did. It's called investment policy statement. Have you devised a clear-cut method for measuring the success or failure of your portfolio? So do you know how to know if it's successful or if it's a failure? Hopefully when we get together we can talk about that and we can compare it to what the markets are doing, and you'll tell me if I'm, coaching you the wrong way or not. Do you finally understand the implications and applications of diversification in your portfolio? Today we talked a lot about that. This should be a yes because we talked about what diversification is and what these correlation charts mean. Now, you may not have 100% grip on it, but you will over time as you come to my classes on a regular basis. Do you have a system to measure portfolio volatility? Again, we're talking about standard deviation. How do I measure that? Expected gain, expected loss, worst case scenario kind of stuff. Are you aware of the incentives brokerage firms and financial communities have when selling commission-based products? Our portfolios are not commission-based products. There's a lot of incentives out there by broker-dealers and these big wirehouses to sell specific products. We've talked about that in the past. A lot of incentives to push a specific product, whether it's right for you or not. Do you know the 3 warning signs that you are gambling and speculating with your money versus prudently investing it? Does anybody know the answer to that one? 3 myths. Market timing, track record investing, stock picking. If you're doing any of those, then you're gambling and speculating with your money. Trying to time the market, when to get in and out, it's too hard to do. Picking stocks, trying to pick them, it's too hard to do. And track record investing. Looking at what some money manager did in the past doesn't mean he can do that again in the future. Can you identify the cultural messages and personal mindsets about money that destroy your peace of mind? We have to go back and do another Mind Over Money class sometime. And if I do it, it's going to be a big one in the back because this is really good stuff. We have cultural messages and personal mindsets that sometimes are embedded in us from when we were a baby. It's how we look at money, how we treat money, our fears with money. And so the only way you're going to get peace of mind is to understand what you're doing with your money, understand how markets work. That's how you get peace of mind. And once you get peace of mind, once you come to enough classes, you start to get a little peace of mind. Okay, I'm in the right portfolio. I'm going to get as good as it's going to get. You start to get peace of mind. And when you have peace of mind, you have more abundance in life because you're not sitting here stewing about and worrying about where your money's doing. So the whole thing about this is everybody has a different mindset of how they view money. It is emotional to us, right? It gets us right here. So, but if we understand how the markets go up and down and how things work, we start to gain some kind of peace of mind. And are you ready to shift your personal experience of money and investing from a scarcity mode to a mode of abundance? And that is part of that peace of mind process. All right. That's all I got on international investing, but I do want to talk a little bit about what's happening today in the market. A couple things going on right now. We had QE buying. Everybody knows what QE buying is, right? That's where the government's been printing money and buying bonds to jumpstart the economy. Been doing that since, 2009? To the tune of $85 billion a month they were buying this to jumpstart the economy. Well, Yellen's in there now. Janet Yellen took over for Bernanke in February. And Bernanke even announced before he left that they were going to slow the buying down. I think they're down to $55 billion, I think I read somewhere now, per month. So at least they're lowering it. We're moving in the right direction. And that means that the government has to have confidence that the economy is getting better or they wouldn't lower the bond buying. And the reason why they do that is they want to suppress inflation rates so that we don't have an early 1980s again. Okay, I'll give you a simple explanation as how I understand it. So what the Fed wants to do is they don't mind keeping inflation rates at 2%. Right now they're under 2% in the eyes of the Fed. I don't know about you, but the last time I went out to eat, it was 2% higher than what it was a year ago, or the grocery store. But we're not going to talk about food and energy, okay? We're just talking about everything else in the world. So they feel that if they can keep inflation at 2% or less, we're okay. They don't want it much less. They really want it right at 2%. So they're afraid if they stop this bond buying and start raising interest rates, that interest rates will jump over 2 and get out of control. This is their whole point. Now, whether it's right or wrong, we're treading territory we've never treaded before, but that's what they're concerned with. How do we keep it at 2%? Because if we can keep it at 2%, we can keep inflation managed well. So this has been the beef. Well, so Yellen came out earlier this month and said, we're not going to raise interest rates till middle of 2015. But I'm going to leave the door open in case something gets better, I might raise them up this year. So the news media loves this stuff because they try to blame every little market gyration up and down about the Fed, their bond buying, they announce this, they announce that, it makes the market jump, makes the market jump. Sometimes it does, but the market has already priced in all this stuff. Okay, all the money managers, all the buyers and traders, they know what, the Fed is not going to make any drastic quick changes, so it really is not going to have a major long-term effect on the market. Now, last year, Bernanke came out and said, we're going to stop buying bonds or lower it big time, and the market went way down. And then 2 weeks later or a week later, he came back and says, oh, I'm not going to do that. I was just, I thought about it. I don't want to do it. And the market went way back right where it was at. So, but that's a short-term gyration. So there's no real long-term threat to the market because the market already knows that the Feds are whacked out with this bond buying and this interest rate thing, and they're not going to go raise interest rates to 3%. They're at 0 right now, basically, and they're not going to go to 3% because they're afraid of inflation. And the market knows it, so you're not going to see any huge gyration out of it. The other thing is that banks are lending more money to businesses. I just read today in the Wall Street Journal that over 8% higher lending in the first quarter of this year than there was the first quarter last year. And the whole article was about the fact that banks are now feeling that the economy is starting to come around. Now, we're not going to read this stuff in Main Street media. They're just not going to talk about it because they're all about emotions. But so if banks are starting to lend to businesses, that means that they have a higher confidence level. It isn't a huge amount, but it's progress. So 8% more loans than there was a year ago in the first quarter. So that's positive news. The NASDAQ, I had somebody ask me today if I thought the market was overvalued. And I don't think it is. And the NASDAQ has been the one taking the beating this year. NASDAQ is mostly tech stocks. And so all the media's been talking about lately is NASDAQ's down, it's a bubble and it's going to blow up like it did in 2001. Well, do you realize the NASDAQ today finished at like 4,200? In February of 2000, it was over 5,000. We're talking 14 years later, we haven't even got back to the high. So do you think it's overvalued? I don't think so. And most of the commentaries from the economists are saying it's not overvalued, but the news media wants to make you think it's overvalued. We're 14 years later and we haven't hit the high we hit in 2000. So I don't think the NASDAQ's overvalued. It has corrected itself a little bit this year. It's down for the year, but not much, 2% when I looked at it yesterday for the year. But the S&P and the Dow, we're just talking large U.S. stocks, are even for the year. So really, through all the turmoil and all the negative talk we've had this year so far, year to date, we're almost dead even. It's not, so that's good because we haven't lost what all we gained last year, which was a huge year. Overseas, the United Kingdom, I read today in the Wall Street Journal, their unemployment rate is at a 5-year low. So that means things are improving in the United Kingdom. That's a good sign. Okay? And also, I think one of the things that I always look at is whatever's going on, remember that there's some stuff going up somewhere in the globe and there's something going down in the globe somewhere, and vice versa all over the place. Back to what we talked about today. And the critical thing is we have a money manager who is rebalancing that every 3 months. So whenever something's up or something's down, they're going to rebalance it. An example would be at the end of the first quarter this year, the NASDAQ was down. U.S. stocks were down a little bit. They bought more bonds, okay? Because the percentage of bonds in your portfolio compared to stocks. Now the bonds went up the first couple weeks of April. Actually, I should say they rebalanced about the middle of April. But the point is that when something's up, every 3 months, these guys are going back and looking and going, well, let's take advantage of what's up and let's buy what's down, because the next quarter, what was down might be back up. That's rebalancing. And that's why it's so critical in our portfolios to do it without us even thinking about it. You and I don't have to think about it, because we wouldn't do it if we did it. We'd be too emotional and go, oh, not buying that NASDAQ. That thing's down 2%. It's probably going to bottom out this year. And when in fact the NASDAQ may go up another 10%. Who knows what it'll do? Nobody knows what it's going to do in 5 minutes. But the point is, rebalance on a regular basis based on what's happened, not what they think's going to happen. Just do it on a systematic basis and we will win that ball game. And we'll pick up 1% or 2%. We'll beat that market by 1 or 2%, hopefully. I mean, that's the goal, at least do what the market does. In the last few years, we've done a pretty good job of beating the market, and a lot of it, I have to say, is because of that rebalancing. I'm not an expert on the details. I don't understand how they do all that, but I know what they do. I just don't know exactly how they do it. But that's their job. That's their specialty. So, overall, there's no bubble. There's no bubble happening. There's nothing out there that shows signs that anything is overinflated anywhere in the market. And in 2001, we had the tech bubble run up of the 90s. Things were overinflated. If you guys were at a couple meetings ago, we did bubbles bursting. It was about how bubbles, you don't even know you're in it, and it finally pops, and that's when it's too late. Well, there's no signs of 2001. There's no signs of 2008. There's no signs that the market's at a bubble, that it's so overpriced that it's ready to pop. That doesn't mean that the market's not going to gyrate and go up and down. It's good for the market to do that. So what you have to do is you got to identify what risk, if I'm going in the market, I got to know what risk level I'm willing to take, because I know it's going to gyrate. What roller coaster ride do I want to get on? Some of you in here might be on a big one, and some of you might be on just a little titchy one. But each and every one of you have a different feeling towards that, and that's our discussions. And if you ever become uncomfortable with the movement of your account month to month, then we need to have another talk. Are we in too much risk? Because if we are, then we need to lower that risk. Okay? Any questions? This class dismissed.